Want to know how the rich got rich? Or maybe you want to know how the rich stay rich. Even if you were born rich, there's still things you want to do to continue to stay rich. Well, the number one entity is investing, which is an essential part of creating wealth and financial freedom. For those of you that don't know what investing is, it's when you put your money into assets with the expectation of achieving a profit. It's when you put your money into financial plans, such as shares, property, stocks and bonds, and many other things. Today I'm gonna reveal to you the top 10 best investments or assets that's proven to really make you rich. All I ask of you is that you like, share, subscribe, and also comment anything else you would like to know more about, or that you would like us to make a video about next. Let's dive right in. The first investment I'm gonna reveal to you today is gonna be real estate investing, which might seem out of reach for most people, and if you mean buying an entire commercial property, that's true. However, there are ways for people at almost every financial level to make money from real estate investments. Just like owning great companies, or owning high quality, productive real estate can be a wonderful way to build wealth, while adding diversification to your portfolio. Publicly traded REITs, or real estate investment trusts, are the most accessible way to invest in real estate. REITs trade on stock market exchanges just like other public companies. Now let's not count out the fact that if you took the route of purchasing the property yourself, which isn't as hard as it seems, as long as you find and follow the proper steps it takes, owning property could make and keep you very wealthy. Finding a way to own some property to rent out to others are at the top of my list when we talk about real estate being used as an asset. This includes buildings, shopping plazas, living units, and really anything you can allow others to pay you to use, mostly with a contract. So before you go and just buy a home, think about buying something that you can rent out and profit from. Up next we have a high-yield savings account. A high-yield savings account is a deposit account, typically offered by online banks and credit unions, offering a much higher interest rate than traditional savings accounts. These accounts pay several times more than the national average of savings accounts, according to the Federal Deposit Insurance Corporation, better known as the FDIC. Understanding what annual percentage yields are, or what APYs are, which are basically the annual returns, can help you make a decision on which account is the best one to bank with overall. One down to these accounts are the higher interest rates, but aside from that, high-yield savings accounts work the same as other savings accounts. You deposit money into the account, and, in return, the bank pays you interest. You can make withdrawals as needed, though your bank may charge a fee if you make more than a certain number of withdrawals per month. So compare interest and compare fees to make this all easy. While high-yield savings accounts are considered safe investments, like CDs, you do run into the risk of losing purchasing power over time due to inflation, like if rates are too low, which is probably the only other main down to these accounts. With that being said, consider leaving your sitting cash in one of these, before a regular savings account. The next one we're going to go over is a certificate of deposit, or CDs, which are issued by banks, and generally offer a higher interest rate than savings accounts. Short-term CDs may be better options when you expect rates to rise, allowing you to reinvest at higher rates when the CD matures. Because of their safety and higher payouts, CDs can be a good choice for retirees who don't need immediate income, and are able to lock their money up for a little bit. A CD works well for risk-averse investors as well, especially those who need their money at a specific time, and can tie up their cash in exchange for a bit more yield than they'd find on a savings account. In a nutshell, a CD is a deposit account that runs over a fixed period of time, typically anywhere from 3 months to 10 years. Designed as a safe and secure way to increase your rate of return, one of the benefits of a CD is that it grows your money regardless of what the market does. The interest earned on a CD is dependable, and it grows thanks to the power of compound interest. Plus, your interest payment on a CD at maturity will often be higher than that earned in most savings accounts. Those CDs are considered safe investments. They do carry reinvestment risk, the risk that when interest rates fall, investors can end up earning less when they reinvest. Just like principal and interest in new CDs with lower rates, as we saw in 2020 and 2021. Up next we have mutual funds, which is a pool of money managed by a professional fund manager, which is a trust that collects money from a number of investors who share a common investment objective, and invest the same in equities, bonds, money market instruments, or other securities. Mutual funds are a type of investment frequently used by retirement or long-term investors. Mutual funds allow investors to own a diversified selection of assets within a single investment. A mutual fund's fees and performance will depend on whether it is actively or passively managed. Many mutual fund minimums range from $500 to $3,000, though some are in the $100 range and there are a few that have a $0 minimum. So if you choose a fund with a $100 minimum, and you invest that amount, afterward you may be able to opt to contribute as much or as little as you want. If you choose a fund with a $0 minimum, you could invest in a mutual fund for as little as $1. Aside from the required initial investment, ask yourself how much money you have to comfortably invest and then choose an amount. One type of mutual fund is actually what we're going to talk about next, which is an index fund. An index fund, much like a mutual fund, will pool investors' capital and buy a portfolio of securities. What distinguishes an index fund, however, some of the other types of mutual funds, is that an index fund is a passively managed fund that merely aims to track a benchmark index's returns, whereas an actively managed fund aims to outperform. An index fund manager buys the exact same securities as tracked by the index with the exact same weightings. Index funds are made up of stocks or bonds that are listed on a particular index, so the risk aims to mirror the risk of that index, as do the returns. If you own an S&P 500 index fund and you hear that the S&P 500 was up 3% for the day, that means your index fund should be up about that much, as well. There are indexes for nearly every asset class and almost every sector of the economy. They track the performance of large cap or small cap stocks, investment grade or junk bonds, and every kind of commodity. Indexes track foreign currencies and international companies. The list goes on and on. Next up are bonds, in which there are three main kinds of bonds. Corporate bonds, which are issued by companies. Municipal bonds, which are issued by state and local governments. Treasury notes, bonds, bill, which are issued by the U.S. government. One risk in the case of some bond funds are that certain short-term corporate bond funds are not FDIC insured. So there is always the chance that companies will have their credit rating downgraded, or run into financial trouble, and default on the bonds. To reduce that risk, make sure your fund is made up of high-quality corporate bonds. Over the long term, increasing wealth is the most important step. But once you've built that wealth, and gotten closer to your financial goal, bonds can help you keep it. Now here we have something called a fixed deposit. A fixed deposit is a type of bank account that promises the investor a fixed rate of interest. In return, the investor must agree not to withdraw or access their funds for a fixed period of time. In a fixed deposit, interest is only paid at the very end of the investment period. A fixed deposit is one of the best investment choices considering the current market and economic conditions, because you get reasonable interest rates and assured returns. Some pay fortnightly, monthly, quarterly, some yearly. A good way to find the best paying rates before you invest in one is by matching interest rates. This next one is another one of the more popular assets out there, which is called stock investing. Stock investing, when done well, can be one of the most effective ways to build long-term wealth. When stocks run up in valuation as they do from time to time, many investors wonder where they can put their investment dollars. Value stock funds may be a good option. Value stock funds are good for investors who are comfortable with the volatility associated with investing in stocks. Investors in stock funds need to have a longer-term investing horizon, too, At least 3 to 5 years to ride out any bumps in the market. You may have heard of this one. An individual retirement account, or an IRA, is an account used to save for retirement. A Roth IRA is a special type of tax-advantaged individual retirement account to which you can contribute after-tax dollars. The primary benefit of a Roth IRA is that your contributions and the earnings on those contributions can grow tax-free and be withdrawn tax-free after the age 59 and a half. Assuming the account has been open for at least 5 years. In other words, you pay taxes on money going into your Roth IRA, and then all future withdrawals are tax-free. The maximum annual contribution amount for a Roth IRA is $6,000, or $500 monthly for those under age 50. This amount increases to $7,000 annually, or roughly $583 monthly, for individuals age 50 or older. Quick example, if you open a Roth IRA and fund it with $6,000 each year for 10 years, and your investments earn 6% annually, you'll end up with about $79,000 by the end of the decade. Lastly, we have here is cryptocurrency, or crypto, which is a class of digital assets created using cryptographic techniques that enable people to buy, sell or trade them securely. Unlike traditional fiat currencies controlled by national governments, cryptocurrencies can circulate without a monetary authority such as a central bank. Most investors buy coins such as Bitcoin, Litecoin, Ethereum, Ripple, and more and wait until their value rise. Once their market prices rise, they sell at a profit. This investing strategy requires one to identify more stable and volatile assets that can shift in value rapidly, resulting in regular profits. By investing roughly $1,000 while monitoring a 10% increase solely on a single combination, it is possible to earn $100 every day in Bitcoin. But this can come with risk, so be smart, do your research and learn the ins and outs before you invest. So that wraps it up. For the top 10 best investments and assets that can really make you rich. Always remember, anything is possible, you just have to put some thought and research into it. If you haven't already, please be sure to like, subscribe and comment anything you would like us to make a helpful video about next. Thanks again for watching.